What we're going to be going over here is cost volume profit analysis, and we're going to be looking at what they call operating leverage. So first off, for our operating leverage equation, this is where we're looking for the degree of operating leverage, and that really equals the contribution margin divided by the operating income here. And the contribution margin, that's simply our sales price minus our variable cost on a per unit basis here, and you take that difference times the quantity that you sell. Okay, so let's go and let's get a definition here of what we mean by this operating leverage. And we're going to be looking at it in terms of a cost volume profit graph here. We're going to have our units sold here on our x-axis, and then along our y-axis, that's going to be our operating income here. And we're going to have a fixed cost here, and we're going to be looking at three different alternatives here where we have fixed costs here that we have to cover before we recognize any positive operating income. And for the three different alternatives, we're going to have a different contribution margin on a per unit basis for each of these alternatives. Now, first off, let's go and let's get our definition here. This operating leverage here, that's really the effect that those fixed costs that we're going to be looking at here for each of those alternatives has on the change, how these fixed costs really affect any changes here in our operating income. And that's really based on the number of units that we sell here, and based on those number of units we sold, we're going to have some operating income here. So operating leverage here, really the effect that fixed costs has on any change here in our operating income as changes occur here in our units sold and also our contribution margin. Okay, so that's what we're going to be looking at. So first, for our three different alternatives here, lay it out in our cost volume profit graph here, and I've gotten each of them shown here in different colors, and these are profit lines that we're looking at here. So first, for our first alternative here, A alternative, we're going to have a contribution margin here of $20 per unit. So for each unit we sell, $20 here is going to go towards operating income or to cover fixed cost. And then along with alternative A here, we're going to have some fixed costs here of $2,000. So remember, the fixed cost here, they're constant over any, so you can have the same fixed cost here if you sell one unit or hundreds of units, just to understand that. And then for alternative B here, we're going to have a contribution margin of $14 per unit. So for each unit we sell, $14 is going to go towards operating income or to cover our fixed cost. And then for alternative B, it's going to have a fixed cost here of minus $1,000. And then for our last alternative C here, we're going to have a contribution margin of $8 per unit. And there's not going to be any fixed cost then. It's just going to start out at zero amount here for operating income. So there's not going to be. So we got three different alternatives here. We're going to have three different fixed costs cases looking at three different fixed costs. And we're going to have three different profit slopes here, or line slopes here. And what we mean by the slope here, that is really the contribution margin on a per unit basis. So alternative A here has a slope of 20 or $20 here, B slope of 14, C a slope of 8. Okay, and what we're going to be looking at here, we're going to be looking at where these three alternatives intersect here at this point here, and that's going to be based on 170 units sold, and that is going to equate to $1,400 here in operating income. And how we really get we'd have to go through that operating income, or our equation here for operating income, but you can just look at it in terms of your line equation here. So Y, our operating income here, equals M, the slope, or the change in Y over the change in X, and in this case for each of those alternatives we went over the slope here. So if we looked at an alternative A here, we'd put in a slope here of 20, number of units sold would be 170, and then we'd have to look at the y-intercept, or where x is equal to 0, where our line intersects our y-axis. So for that first alternative here, where we had the slope of 20 here for slope of 20 here, 170 units sold, we'd have to look at the y-intercept here or the fixed cost. Our y-intercept is our fixed cost here, a negative $2,000. So if you plug your numbers in here, $20 here times 170 units, and you subtract out the $2,000 here in fixed cost, you're going to come up with your operating income or your Y amount here of $1,400. Okay, so we're going to look at it in those terms. We're going to look at our units sold here of 170 with our operating income here of $1,400 and understand what that degree of operating leverage is based on those amounts here. So next thing we have, and again remember each one of these lines here has a break-even point here. Anything below, in this case we've got a break-even point for each alternative here, but anything below our break-even point we're looking at the loss. That's where these fixed costs are going to come into play. Okay, so again, this point here, the 170 units at $1,400 in operating income, this is where we're going to look at the change in operating income here based on that degree of operating leverage. So first off, let's go through our example here with our calculations. So our total contribution here, that was, and we'll look at each alternatives A, B, and C here. So for alternative A, total contribution, and that's the contribution margin that we're really looking at, 170 units sold times $20 here per unit, that's going to give us $3,400 here in total contribution. Now how is that divided up here? So first off, we have to cover our fixed costs. So we have that $3,400 here in total contribution. Subtract out your fixed cost here at $2,000. So the remaining amount here is going to give you your operating income here of $1,400. So we covered our $2,000 worth of fixed cost here to come up to our break-even point here, and we had a negative operating income up to that point here, and then beyond that we generated that $1,400 here in operating income. I went through the line equation here, but then looking at it based on our total contribution here as well. So the next for alternative B here, 170 units sold times the $14 contribution margin per unit is going to give us $2,400 here of total contribution. And that again would be dividing it up here to $2,400. $1,000 goes to fixed cost here. So the remaining amount here would go towards our operating income here, $1,400. And then for alternative C, 170 units times $8 here per unit contribution margin is going to give us $1,400. So here we didn't have any fixed cost to cover, so we just have total from 0 here to $1,400 here. Now I'm rounding these numbers off. If you actually multiply them out, you may get slightly different numbers here, but they're just based on a round off, so it's easy to understand what's going on. Okay, so now let's look at our degree of calculate our degree of operating leverage. So this is what it's all about. This is the case here where you take your contribution margin here and divide it by your operating income based on our equation here. So in looking at each alternative here, A, B, and C. So for alternative A here, we had what? Total contribution margin of $3,400. Our operating income here was $1,400. So that's going to give us our degree of operating leverage divided out. It's going to be 2.43 here. So that's how you calculate your degree of operating leverage based on that original equation that we looked at. So the case here, when we're going to be looking at these different decreasing or increasing numbers here and these degree of operating leverage based on those three different alternatives that we're looking at. But what we're going to be looking at here is when you have a great, and in this first case A here or alternative A here, we're going to have a greater degree here of operating leverage than the other alternatives. And really what that is saying here, the greater degree of operating leverage, that is where you're going to have a small change here in sales is going to equal a large change here in operating income. So that's how you look at the degree of operating leverage, and we'll go through that. Okay, so for alternative B, what do we have here? $2,400 in total contribution, again divided by our operating income here of $1,400 gives us a degree operating leverage here of 1.70. And then for alternative C, well, what do we have? 14 here in total, 1,400 in total total contribution margin here, divided by our operating income here of 1,400. That gives us 1. Okay, so you can see here when we had that greater amount here of contribution for alternative A here, we went from a negative 2,000 up to a positive 1,400. That was that total swing here of $3,400. Again, divided by our operating income here of 1,400. That gave us that larger operating leverage here of 2.43. So what they're saying here, that greater degree of operating leverage, a small change in sales. So you've got this real steep line here. So if you get a small change in your units sold here, you're going to have a greater change here in operating income. And you can just see it by looking at your total operating income here. For alternative A, we had that 3,400. Now remember, our operating income, that target amount that we're making our comparison with, hasn't changed here. So for alternative A, you got the larger operating income here, 3,400. You're going to have the larger degree here of operating leverage here. And then on down for B and C, they're less. 2,400 here for B, a lesser operating leverage number here, degree of operating leverage. Okay, so you understand what's going on here. Okay, so that's really how we determine here a degree of operating leverage. Simply determining what your total contribution is here based on some point here where you look at your units sold versus your operating income on those units sold. And we just did it at in an intersecting point here. You could do it at any point here between these three different alternatives, but we're doing it here to get our understanding of our degree of operating leverage. Okay, so now let's just go down here one more time here and say, okay, going over this again here. Our operating leverage, really it's the effect of the fixed costs. Those are the fixed costs that we looked at for those three different alternatives. And the effect that these fixed costs here has on the change of operating income. And that's based on the changes that occur here in your units sold and that contribution margin. So the steeper the line here, our profit line, the greater the contribution margin, the greater here our least our change in operating income. And then based on that, you're going to have a higher degree here of operating leverage. So the steeper your profit line is here, the greater degree of operating leverage you're going to have. The less the slope here in your line, the lesser amount of operating leverage you're going to have. Okay, and then one last thing here before we move on. Again, the greater degree of an operating leverage, that means the smaller a change here in your sales that you have, the larger change in operating income that we looked at. Simply looking at the slope of those profit lines here for each of those alternatives. So really what that's saying here is if you have small increases in sales, you're going to have larger increases in overall in operating income. But if you're going to have small, it works just the opposite here. So if you're going to have small decreases in sales, that's where you're going to have large decreases in operating income. So you're going to have greater risk of an operating loss here if you're going to have small decreases in sales. Okay, so what we're saying here is at this point here, this was the intersecting point here. Now, anything on the other side of the line here, this is the case here where if you have any small change in sales here on this side of our equilibrium point here, essentially, this is where with the steeper line here, you're going to have greater operating income or larger increases here in your operating income. But if you go to the other side of the line here, that's just the opposite. So if you're going to have small decreases in sales from whatever you've got a targeted amount here, then you're going to have greater losses here that you're in your, or greater reductions here in your operating income. Okay, so that was our three different alternatives we're looking at. Just remember those fixed costs here are really affect what's going on here in your degree of operating leverage when we looked at our equilibrium point. Okay, so let's go down here and let's move over here. So how does our operating leverage really affect our sales? So this is the case here where we had those we looked at that equilibrium point here, or where the lines intersect. They all have the same, for the same number of units sold, we have the same operating income. Now we're going to look at the case here where we're going to actually look at where our sales increase here by 50%. So we're going to move up from that 170 units that we sold here up to 255 units, and we'll look at each of those different alternatives here, A, B, and C. Okay, so again, the degree of operating leverage here has on the increase here in sales, and we're looking here on the case here where we are looking on this side of our equilibrium point, where we have any positive changes here, or any increases in our sales here are going to actually increase our operating income in all three cases. So going back to our example here, this is the case here where, again, degree in operating leverage, this is where we're going to look at our increase in sales. So this is our operating leverage that we calculated for each of those different cases here, A, B, and C, and this is what we're going to be looking at, our increase in sales. So if we're looking at alternative A here, that operating leverage here, what we calculated that here, degree of operating leverage was 2.43 times 50% here in our increase in our sales. That's going to ultimately change here our operating income. It's going to increase our operating income by 122%. So we had at 170 units here, we had, in all cases, we had that $1,400 here in operating income. So for alternative A here, we're moving up from $1,400 here in operating income by 122% to $3,100 here in operating income. Okay, and then I got everything rounded off here, so come up with some even numbers here. And then for alternative B, our degree of operating leverage here was 1.70, again, times your increase of sales here of 50%. That's going to give us 85% here increase in our operating income. Again, moving from $1,400 here in operating income up to $2,600. And then for alternative C, well, we had just that degree of operating leverage here was 1.0, or it had just even here. We didn't have any operating leverage at all due to the fact that we didn't have any of those fixed costs that we're covering here. And our line, we had a sloper, less of a degree here, or less slope here in our line here. It just come out to 1.0. Take that times our 50% sales increase, all you're going to get is a 50% increase in sales. So this is the case where we went from $1,400 here up to $2,100. So you see what's going on here. The larger the degree of operating, our degree of operating leverage here, that gave us a larger increase in our sales, and that generated a greater amount here of operating income. Okay, so that was looking at the sales increase here of 50%. Then one other thing we want to talk about here, we want to look at this degree of operating leverage. Any changes here affect, there's different, looking at the case here where we had a change here of 50% in our sales, or we went up to 255 units here that we sold, we're going to have a different, we're going to have to calculate a different degree here of operating leverage. So just going back to our problem here that we had, so we have those 255 units here that we sold, and we're going to be using those same contribution margins here for each of those different alternatives. We'll be using the same contribution margins here on a per unit basis here, A, B, and C. So this is how we calculate that change here in a degree of operating leverage. So for alternative A, 255 here times $20 here per unit gives us a total amount here, $5,100 in total contribution. B here, 255 times 14 gives us $3,600 in total contribution. And then for alternative C, 255 times $8 here per unit gives us $2,100 here in contribution. So now we can figure out our degree of operating leverage based on those different level of sales here. Simply take our total contribution here of $5,100 for A divided by the $3,100 here in based on that 250 total our operating income here, and let's go up and look at it so we understand what's going on. For when we recalculated that our operating income here based on that sales increase, we came up here with $3,100 here for alternative A. It increased from $1,400 here by 122% up to $3,100. So this is where we're going to come up with that new degree here of operating leverage. So again, taking our total contributions here, 5,100 divided by 3,100 here, our new operating income here at 255 units sold. Our degree of operating leverage goes here down to 1.65. And just compare it to what we had before. We were sitting here at 2.43 for alternative A here. But by changing our, looking at it based on our new sales or our new sales here, or change here in our sales, we're coming up with that different degree here of operating leverage. And for B here, simply taking our total contribution here at 3,600 divided by 2,600, those were those sales that we have up here, that operating income based on those 255 units sold. The division here gives us a degree of operating leverage of 1.38. And then for the last alternative C, well, we didn't have a degree, it was just 1.0. 21 here, 100 here in total contributions divided by that 2,100 that we generated in operating income here, 1.0 here. Okay, so again, by our equation here, this degree of operating leverage that we're looking at here, that equals our contribution margin that we have here divided by the operating income that we had. Okay, so that's basically what we're talking about here when we talked about this degree of operating leverage and how it's really affected here by the number of units you sell and the operating income that you generate based on those units you sell. And then you're going to have, it's affected here really by, again, your slope of the line here and also your fixed cost that you have to recover here before you generate any positive operating income. Okay, so that's what we're talking about here when we talk about operating leverage.